Hey everyone, welcome back to Smart Wealth Code. Amidst all the chaos last week, the world's largest asset manager, BlackRock, quietly dropped a bombshell that should be making a lot of investors extremely nervous. They announced they are limiting withdrawals from one of their flagship private credit funds, a fund that manages around $26 billion in assets. Investors asked to pull out roughly $1.2 billion, about 9.3% of the fund, but BlackRock only approved about $620 million, capping redemptions at the standard 5% quarterly limit. Now, I know there's a lot going on in the world right now, and this might sound minor compared to other headlines, but trust me, a hiccup like this in private credit could be an early sign, symptom, and potential cause of something much bigger. On one side, people rushing to pull money out is a clear signal that even sophisticated, high net worth investors are getting worried. On the other, the fact that they can't easily get their cash is a symptom that liquidity is drying up. And on the third hand, millions of everyday businesses have been kept afloat by easy lending from these funds. If that credit tap slows or stops, the knock on effects on the real economy, jobs, investment, growth could be direct and painful. But before we get carried away, let's understand exactly what private credit is and how we got here. Traditionally, companies borrowed from banks. After the 2008 crisis, regulators forced banks to hold more capital and become far more cautious. That opened a massive gap, and giant investment funds stepped in. Blackstone, Apollo, Ares, Blue Owl, KKR, and yes, BlackRock. These funds raise money from investors and lend it directly to companies on privately negotiated terms. It's called private credit, and it has exploded into a multi-trillion-dollar market, now estimated around $2 trillion globally, with some forecasts pushing toward $3 trillion soon. It includes direct lending, asset-backed loans, real estate credit, infrastructure, and more. Investors loved it because these loans, mostly floating rate, delivered high yields, often 8%, 10%, or more, especially when interest rates were near zero. But the environment has changed dramatically. The Fed hiked rates aggressively and borrowing costs for companies surged. Firms that once paid 4 to 5% are now paying 10% or higher. That's crushing for heavily indebted businesses. Warning signs are everywhere. Credit rating agencies are issuing far more downgrades than upgrades. Delinquency and default rates are climbing. Recent data shows U.S. private credit default rates hitting records around 5.8% to 9.2% in recent readings, well above historical averages, though still below full crisis levels. And now, redemption pressure is building across the industry. This isn't just BlackRock. Blue Owl has faced major redemption issues, even halting some withdrawals and selling assets. Blackstone recently had to lift its own limits and inject capital. Morgan Stanley and others have made headlines too. The giants may survive, but smaller or stretched players could face serious trouble. Here's the core problem: a liquidity mismatch. Many of these newer funds, especially semi-liquid ones aimed at wealthy individual investors, let people request withdrawals every quarter, but the underlying loans often last 5 to 7 years. When redemption requests spike across multiple big funds at the same time, it's no longer an isolated event. It's a red flag. This market grew explosively for three big reasons. Number one, banks retreated. There are far fewer banks than 40 years ago. Big banks prefer standardized, scalable products like mortgages and credit cards. Post-2008 regulations made them even more reluctant to lend to mid-sized companies without tons of collateral. The companies in the middle, mostly mid-sized businesses, are now feeling real pain. Job numbers have been revised downward repeatedly. Layoffs are rising as firms cut costs to handle higher interest expenses and weaker customer demand. Fewer customers mean less revenue, which risks more defaults, creating a dangerous feedback loop. Private credit has become a huge part of the shadow banking system, performing bank-like functions with less regulation and transparency. Is this the next 2008? Not exactly. The loans aren't subprime mortgages financing homes, they're financing businesses, payroll, inventory, and operations. The economy and banking system are larger and better capitalized today, but the market is now enormous, opaque, and grew rapidly in an ultra-low rate world. Rapid growth, followed by higher rates and slowing growth, has historically been a recipe for painful adjustment. Right now, we're seeing early stress signals, not full panic. Most loans are still performing. Defaults are elevated but manageable for now, and funds have built-in limits. But when several major players face redemption pressure simultaneously and defaults keep trending higher, it's worth paying very close attention. The big question, will private credit navigate this adjustment phase smoothly, or will rising stress reduce credit availability, force businesses to cut back on hiring and investment, and spill over into the broader economy? This market has become too important to ignore. Regulators and smart investors are watching it closely, and so should you. That's today's deep dive on what's really happening in private credit and why BlackRock's quiet announcement matters more than it first appears. If you found this helpful, drop a like, subscribe to Smart Wealth Code, and let me know in the comments. Are you invested in private credit or alternative funds? Do you see this as a buying opportunity or a major warning sign? Also, check the description for links to more on how private equity debt works and the latest corporate bankruptcy trends. Thanks for watching. Stay informed, stay smart with your wealth, and I'll see you in the next one.